Let's now get the thoughts of Domini Velasquez, China Bank Chief Economist. Domini, thank you so much for joining us. You heard our kababayans, they are still complaining that this lower inflation, they're not feeling, especially in the markets and in the supermarkets. Personally, from your research, do we really feel this 6.1% inflation rate?
Hi Rico, good evening. So I guess when you think about how much you feel the inflation rate is just a growth rate, right? Since we got high prices before, prices are still increasing just by a lower rate right now. So I guess that's where the complaints are coming from. But hopefully this kind of price increases that we experienced last year, early this year, we won't have that moving forward anymore.
And we've seen inflation on a downtrend for the past 4 consecutive months. Is this sustainable?
We think yes, it's likely going to happen. I think that's the most likely scenario just because of favorable base effects. Last year we had prices going up. Now, because inflation is a growth rate, we can see smaller and smaller increments of this inflation rate moving forward.
And of course, the central bank, Domini, has a 2 to 4% target in 2023 with expectations of a further slowdown in September or October. Is this a possibility from the current 6% down to between 2 to 4% in several months?
For us, the bigger chance is around October or November. When we do computation, we see it going down to maybe 4% October. So we've actually moved up our expectation of the 4% inflation rate from November to October. But right now, we're not seeing it happening in September. Q4, likely scenario for China Bank.
So at 2%, which is the low end of the inflation target of the central bank, is not possible for 2023?
Not really for 2023, 2024 maybe, first few months of 2024. Again, we're working with that base effects because we had 8.7% inflation in January last year.
6.1% in the month of May. How does our inflation rate, Domini, compare with the rest of Southeast Asia?
I guess for the rest of Southeast Asia, it's fairly low already. Most of the ASEAN economies are already within their target. This is really because we had domestic-induced shortages at the start of the year. So even when oil prices came down and all other ASEAN economies benefited from it, ours was partly offset by these domestic shortages that we experienced.
So if your outlook is at around the 4% level by the last quarter of 2023, do you think it would be time then for the Bangko Sentral to start cutting interest rates to further boost the economy?
I think there's room for the BSP to cut rates by Q4 just because inflation will be within target. In 2024, we think inflation will be firmly within target. Our estimate is actually 2.9% inflation in 2024. So there is room for them to cut rates. But of course, for the BSP, interest rate differentials with the Fed will matter. Right now, it's at 100 basis points. It has stabilized the peso from that 59 high last year. So they'll likely look at how much the peso will depreciate, if it will become inflationary, if it depreciates.
And when you say 100 basis points, that's about a full percent, right, on the interest rate chart.
Yes.
But Domini, I mean, we are having issues over the past few months. You have power outages, water shortages, the potential El Nino issues. Could this jumpstart inflation once again this year?
Yes, that remains a risk. I think the BSP has also highlighted El Nino phenomenon as a key risk to their outlook. So not just water shortages or power shortages, but also its impact on your food prices, for example, on rice, on vegetables. It was mentioned a while ago that rice prices have been increasing. So this is not just happening domestically, but globally, rice prices have been increasing because of El Nino. So because we import a lot of our rice also from Vietnam and Thailand, we're also affected by higher prices globally.
Could OPEC also be a major risk over the next couple of months? led by Saudi Arabia, they will be cutting oil supply starting in July, which means less oil in the markets, which could jumpstart higher prices once again. Could this have an impact on inflation yet again?
Yes, yes, of course. Oil prices really pushed up inflation last year, right? I think for the second half of the year, the global outlook for oil is limited supply. So there is a risk of oil prices increasing inflation yet again. However, we also have a slowing of economies in advanced economies, so the US, in Europe, so that might offset some of these supply issues with regard to oil.
But could these risks that we just discussed also stifle economic growth, which kicked off at 6.4% in the first quarter of this year?
Yes, of course. I mean, I think globally, I think generally the economic managers have actually reduced their growth target to 6 to 7% for the year, really because you have these economic headwinds. Trade has been down for the first quarter, exports is down, so that will affect the economy. On the good side, though, the Philippine economy is very much demand-driven, domestic demand-driven, and consumption-driven. So this has actually insulated us from this economic downturn. Even if you look at historical downturns, the Philippines was less affected as compared to other neighboring countries like Singapore or Thailand, who's more dependent on trade.
So what is China Bank's outlook for the remainder of the year in terms of monetary policy? Will the Bangko Sentral hold off on further interest rates?
For us, I think likely the BSP will hold this 6.25%. Inflation is going down already. A key risk is, of course, actions of the Fed, which dictates sometimes the actions of other central banks, just because it's the most powerful just because the Fed is the most powerful central bank. And sometimes, because you want to keep interest rate differentials, you move in line with the Fed. Hopefully, though, even if the Fed raises rates maybe in July, interest rate differential will matter less, and inflation will matter more in terms of the outlook.
Thank you so much for your outlook on inflation and the economy. Domini Velasquez, China Bank Chief Economist.